Welcome everyone. We will be talking about the project analysis, studying the project in different dimensions to understand why the project has been carried in the first place, what was the impact that it happened around it, and in short, we will understand the outcome of the project. And that is what project analysis is all about it. Yes, we are talking project analysis in terms of the cash flows. The agenda is very simple, very straightforward. We will talk about NPV as the net present value estimate. So project analysis in terms of revenues that we are generating, the cash flow that we are generating, scenario and other, as in what if analysis that comes around it. We'll talk about BEP or the break-even point or break-even analysis, OCF or the operating cash flow, SV the sales volume, BE is break even, the sales volume, the operating leverage, the capital rationing is what we will be talking in this presentation. This presentation would be a little bit mathematical oriented. I believe the audiences would have the patience to understand it. Simple presentation, small video, just watch it, have it. Probably if you require, you can pause it, reflect it, and repeat this video a number of times for you to have a clear understanding. Now let us understand NPV, net present value estimates. Now what are NPV? Let's say $100 today might get me approximately a week's lunch and dinner. In today's world, $100 is what I will be spending for a week's lunch and dinner. But will it be the same $100 who is going to purchase me the full week's uh, lunch and dinner in next 20 years? Probably no. Why? Because in next 20 years, inflation would creep in and eat into the value of the dollars, right? So for $100 after 20 years, probably I'll be managing only lunch and dinner for 2 days, probably 3 days, not beyond it. Why? Because of inflation. Now, this is what we are looking into at a net present value. Net present value are just the estimate. A positive value is a good start. And now we need to understand and take a very closer look what we are looking into it. Forecasting risk, how sensitive is our net present value to change? Did I spoke about the $100 purchasing power of today's lunch and dinner for 7 days, and 20 years hence it might only purchase me 2 days of lunch and dinner or probably 3 days of lunch and dinner. So that is what is the forecasting around it. How sensitive is your NPV? Remember, lunch and dinner is what will remain constant. $100 was also remaining constant, but the price or the value of $100 have diminished over a period of time in next 20 years. Source of value, why does this project create value in the first place? Scenario analysis, what happens if the net present value you under different cash flow? I will be talking about the different cash flow systems altogether with you in this video altogether, right? We will have a best case scenario, the worst case scenario, the normal baseline scenario. Oh yes, it's mentioned out here. We will talk about those three scenarios. The best case, high revenue, low cost. Absolutely, it's a cash cow. Worst case scenario, low revenues and high cost. I'm putting in money, but probably it's not giving me enough to sustain, and measuring of the range of possible outcomes thereby. So best case and worst case are not necessarily probable, but they can still be possible. So you should be optimistic and pessimistic. Probably neither the optimistic things happen, neither the pessimistic things happen. So one needs to be realistic, but should be prepared for either of the avenues of being positive or negative outcomes. Let us discuss this project. Let's say the initial cost is $200,000 of a 5-year term. Remember, there is no salvage. Absolutely, the good goes down the drain. Depreciation is simple, straight line, 12 at the rate of 12%. The tax rate is around 34%. The base case net present value is 15,564. Simple project. Please understand, a project worth $200,000 with a straight line deficit, a depreciation of 12%. The project lasts for only 5 years and not beyond it. The tax rate is stupendously high at 34%. So essentially what happens, let us assume that base case net present value is 15,567. Now this is the base case after the end of 5 years. Remember, this is what we are looking into it. So summary, now let me give you the base case, the worst case and the best case. Now, what is the base case? Did I say NPV? This is what I have assumed around it. The internal rate of return is 15.1%. The cash flow is around $59,800, and the net income is approximately $19,800 with a rate of 15.1% on a scale of $200,000 that has been invested. Whereas in the worst case scenario, what happens? I am not even longing for 5 years of extension. Probably I wind up at the end of 3 years. Why? Because the cash flow is absolutely low at $24,490. The net income is I'm always putting in money. Come what may, I'm always putting in money. The net income is always negative. So internal rate of return is a loss-making venture. This is the worst case scenario, believe me or not. Whereas the best case scenario, something stupendously well and good. The net present value after at the end of 5 years is something where around it's approximately $159,504 that it goes around. The cash flow is amazingly good. Approximately 50% of what we are looking into it is coming back. Is $99,730. The net income is approximately 30%, around $59,730. So if this is 30% over the initial 200,000, what is the internal rate of return? Stupendously high at 40.9%. Now this is a summary of a scenario analysis that comes around it. Now talking about sensitivity analysis. What happens when NPV, when either of the variable changes over a period of time? This is a subset of scenario analysis. Now, what is a subset of scenario analysis? Is something where the outcome can be yes and can be no. Let's say it can be yes, it can be no. Right. So what happens if the scenario goes your way or in not your fashion or not your way? The greater the volatility in NPV in relation to a specific variable, the larger the forecasting risk associated with it. The variable, the more attention we want to pay to its estimate, and that is what we are looking forward to, and that is what sensitivity analysis is all about it. Again, keeping back things in the same perspective, if we look into it, and we are changing only one thing or the other things. Remember, in the base case scenario, my NPV remains the same thing. I don't have to change around here, but the cash flow changes, and cash flow is always healthy. Absolutely, it is always healthy. As a result, what happened? The unit sales at base case is 6,000. At the worst scenario is 5,500. And the best case is another 500 unit excess than the base result. So it's approximately healthy, and that means the internal rate of return is also very healthy. Now this is something which is much more realistic. It is sensitivity analysis at the best of it. In the base case scenario, the IRR, the internal rate of return is 15.1%, the worst case 10.3%, and the best case around 19.3%. Something which is amicable. You never indulge a project which with having a negative sales. So that is something which needs to be taken into consideration. The simulation analysis. Simulation really is an expanded sensitivity and a scenario analysis. Monte Carlo simulation can estimate thousands of possible outcomes based on conditional probability, distribution and constraint of each of the variable. The output is probability distribution for net present value with an estimate of probability of obtaining a positive net present value. The simulation of only works as well as information that is entered, and very bad decision can be made if care is not taken to analyze the interaction between the variables as the case might be, and we are talking exactly what we want to go around it. Simulation is nothing but an extension of sensitivity and scenario analysis. It comes up with the probable outcomes that can be having with the conditional probabilities of distribution of constraint. The output is perfectly in tune with the net present value. So making a decision, beware of the paralysis of analysis. Remember, if you make too much of study, too much of alternatives, and each alternative is actually as attractive as the other one, you will end up not taking an action onto the alternative. So it becomes a paralysis of analysis. At some point, you have to take a decision. If the majority of your scenarios are positive NPVs, then you can feel reasonably comfortable about accepting a project. Even your worst case scenario is positive, the best case scenario is positive, the base case scenario is always positive, which has been done. So what you're looking into it, if things are going in a positive way, all the way around, even in the worst of the situation, it doesn't make much of a sense to negate that project, right? You should always accept that project. If you have a crucial variable that leads to a negative NPV with small change in the estimate, then you may want to forgo the project thereby. Allow me to come to break-even analysis or break-even point, common tool for analyzing relation between sales volume and profitability. There are three common break-even measures. First is the accounting break-even, where net inflow is zero. The other would be cash break-even, where the organizational cash flow is zero. And financial break-even, where the sales volume is at zero, the net present value is zero. So accounting is where you are keeping a book of account, the net inflow is zero. Cash break even is where the cash coming in, the transaction coming in, the revenue in, and the expenditure that needs to be maintained is zero, doesn't adds up. And the financial break even where the net present value is zero altogether. So example cost. Let me talk about it. There are two types of cost. Everybody understand. One is a fixed cost and the other one is a variable cost. Fixed cost is the cost which we need to pay come what may. If there are production in the house, in the company, we have to give a fixed cost. If there are no production, we still have to maintain that amount of cost. Right, sure. But when we are producing something, there's a variable cost because number of unit we produce, number of resources being consumed. Unit products, the marginal cost increases, and that is what the variable cost is all about. It variable cost is all about quantity into the number of costs per unit that goes around it. Fixed costs are constant regardless of output, regardless over a period of time. So total cost TC is equal to fixed cost plus variable cost. That VQ that we are going around it. So let's say your firm pays approximately 3,000 a month in fixed cost and you pay $15 per unit to produce your product. So what is your total cost of to produce 1,000 units? Let's say that means 1,000 units will be 3,000 plus 15 into 1,000. That means 15,000, right? 15,000 plus 3,000 will be 18,000. So what will it will make about 5,000 units? Then means 15 into 5,000 would be 45,000 dollars plus 3,000, 48,000. For 1,000 you are requiring 18,000 dollars. For 5,000 unit you are requiring $48,000. Now this is your cost that comes around here. This is what we need to keep in mind. That is an example that I'm trying to give it to you and push it around it. So average versus marginal cost. What is an average cost? Average cost is the total cost divided by the number of units. The total cost divided by the number of units. It will decrease as the number of units will increase. As the denominator number increases, let's say the total cost is $100 and the number of units is 10. So the average cost will be around $10. But what happens if we increase the number of units by 100? The average cost becomes $1 in that scenario. So see, it will decrease as the number of units gets increased. Marginal cost, the cost to produce one unit, same as the variable cost to produce per unit. Example, what is the average units that we go around it? If we are talking around approximately. So this is what we need to understand every now and then. So produce 1,000 unit, average is 18,000, approximately $18 divided by 1,000. Produce 5,000 units is 78,000 divided by 5,000 is $15.60. Now you see the average prices goes down, and that is what we want to hammer around it. Three types of break-even analysis. Accounting. Remember, accounting break-even when net inflow is zero. That means quantity is fixed cost plus the depreciation minus the present value and the variable cost that goes around it. Net inflow is absolutely zero. Cash break-even is where organization cash flow is zero, the fixed loss. The organization cash flow divided by the present values and the variable cost, ignoring taxes, is what we are looking as a cash break even. Absolutely, it becomes no sense if there are no cash flow. Probably it is profitable, but cash flow is zero. Financial break even where net present value is absolutely zero altogether. Come what may, you are not making changes. So what happened? Essentially, please remember this: that cash break even is smaller than accounting break even. On the other hand, accounting break-even is again smaller than the financial break-even. So this needs to be understood. Remember, financial break-even is much more important than accounting break-even, then cash break-even. The other way around to put it across. Cash break-even is smaller than the accounting break-even, which is even smaller than the financial break-even. So, which is most important? Financial break-even. Or should I put it in other words? Financial break-even is more important than the accounting break-even. Accounting break-even is more important than the cash break-even. Capital rationing. Capital rationing occurs when a firm or a division has limited resources in terms of manpower, in terms of material, in terms of cash, in front of revenue generation mechanism. So we have a soft rationing. The limited resources are temporary, often self-imposed. Hard rationing with the capital will never be available for this project. The profitability index is a useful tool when a manager is faced with a soft rationing per se, and that is what we should all strive forward to. Before we wind up this particular presentation, now I love to give the audience a ethical issue that keeps on bothering me. Just to put it across as a food for thought, is it ethical for a medical patient to pay for a portion of research and development costs? Let's say the experimental procedures are not covered by insurers prior to the introduction of the final product. Is it proper for the physician to recommend such procedures when they have vested interest in their usages? Vested interest, they are going to skim off money. Definitely, yes. They will. They have vested interest of gaining uh, an experimental drug on a patient for their own consumption, for their own academic interest, for their own understanding. The outcome may not be positive to the patient. So how does it matters it around it? Should it be charged? Should it be complimentary? Should it be notified to the patient? Should the doctors enjoy it? How to go across with it? Remember, the patient is almost in the terminal disease, suffering from a terminal disease on the deathbed altogether. How to go around it? How to avoid by it? This ethical issues per se. Before I wind up with this, I just want to finish up the project analysis per se. Remember, the ethical issue is also a part of the project of developing a new drug for the humanity thereby. Thank you for watching this presentation till the very end. Thank you very much, all of you. Have a nice day.